Good morning. This hearing of the Committee on Agriculture to review the impact of G-20 clearing and trade execution requirements will come to order. Good morning. Thank you for joining the Commodity Exchanges and Credit Subcommittee for our last installment of our three-part hearing series examining the implementation of the derivatives market reforms envisioned by world leaders following the 2008 global financial crisis. Today, we'll wrap up the series with a focus on clearing and trade execution requirements. Throughout this series, we've reiterated many times that our goal is not an indictment of the reform objectives, but rather an analysis of its implementation by the United States regulators and the interaction of the U.S. regulatory regime with that of other global jurisdictions. A vibrant and resilient derivatives marketplace is crucial for market participants and end users who rely on it to manage their diverse business risk. It is also critical for the consumers, Americans in the 8th District of Georgia and across this nation who rely on the price stability afforded by these risk management practices. Crucially, the global nature of this marketplace cannot be taken for granted. Regulations must not unnecessarily fragment the market, defining liquidity pools by borders instead of market needs. We have already had many conversations on cross-border equivalence and recognition in the clearing space. While we are encouraged by recent steps toward U.S.-EU regulatory harmonization with clearinghouses, applications to European Securities and Market Authority for U.S. clearinghouses to be recognized remain outstanding with a quickly approaching deadline. I'm told this will be done soon, but this process has taken far too long. Equivalence, recognition, and substituted compliance decisions must be resolved more quickly. Regulators need to be working now to prevent similar protracted negotiations for trade execution facilities in the future. We're glad to have witnesses before us today who can expound on the changes to the clearing ecosystem. While transaction clearing has long played a role in the marketplace, Dodd-Frank swaps clearing mandate has significantly expanded the volume of cleared transactions. I'm sure that the insights and perspectives offered today will be vital as we think through the related implications of resilience and recovery of clearinghouses in times of market stress. Many questions have been raised about the workability of the CFTC's trade execution rules. Do they accurately reflect congressional intent and sufficiently take into account the intricacies of the marketplace they regulate? Do they restrict market access for the end users who need to meet specific and custom hedging needs? And perhaps most importantly, do they impose arbitrary barriers to trading that diminishes liquidity? We look forward to exploring these and other issues more deeply today. In developing their market reform framework, G20 leaders were clear about the need for global regulators to collaborate and coordinate on these rules. They saw consistent implementation of reforms as preventing regulatory arbitrage, protecting financial stability, and promoting competition and innovation. This, too, is the standard by which we measure our regulatory process. With that, I want to welcome our panel of accomplished witnesses who bring their diverse viewpoints on clearing and trade executions. Thank you each for the time and effort you put into being here today. We look forward to leaving here with a deeper understanding of the issues at hand. And I will recognize our ranking member, Mr. Scott, for any remarks he'd like to make.
Thank you, Chairman Scott. It's a pleasure to be here. This is indeed an important and very timely issue. As we know, the derivatives, the swaps market that we're dealing with is over an $800 trillion piece of the world's economy. It's very complex, complicated, and oftentimes all too confusing. So I thought we might give just a little background to sort of set the stage for how we got here. As you all remember, after the financial crisis, the derivatives markets were dramatically transformed by Title VII in the Dodd-Frank Act. And Title VII falls directly under the purview of this committee. It is a section relating to derivatives, a large swath of CFTC and SEC mandates. These are our regulators in this area. And one of our major concerns is to make sure that our two regulatory agencies themselves can harmonize and make sure. And that's a very important mandate for our committee to make sure of. This included rulemakings pertaining to clearing, trade executions, reporting, and transparency obligations. Then we come back a little earlier. In 2009, the G20 proposed reforms to the derivatives markets with a particular emphasis on making sure a global standard is met so that harmonization in our rules could be met. The United States' response to this G20 summit was Dodd-Frank, while other countries have implemented their own laws with varying timelines, which creates another problem. This mismatch in timing has led to a slew of equivalency problems, none greater than what's happening in the European Union. For example, the EU will soon implement a rule that is not and could not be as strong as the United States rule. And given the global nature of our world's derivatives markets, equivalency problems have led to many market participants going from one place to another. And so on Tuesday, May 24th, the CFTC issued a final rule that applies to the Commission's margin requirements for uncleared swaps in the context of cross-border transactions. This rule would limit the ability of banks and other traders to move swaps businesses abroad to avoid U.S. trading requirements. And this is something we need to hear from you, how it impacts our industry. The rule requires that offshore units of U.S. banks to adhere to CFT margin rules even in cases where the unit's American parents aren't explicitly off the hooks for trades. Now, just to refresh your memory, swaps did get a bad name during the financial crisis because of a certain swap called the credit default swap. It's a key over-the-counter derivative. During that crisis, if you recall, the AIG issued a huge amount of CDS contracts paying out similar to an insurance contract when collateralized debt obligations collapsed. This was hugely speculative and has since been corrected because a version of it has been targeted by U.S. policymakers for greater oversight and transparency because they played a central role in the financial crisis. So we come to December 2015. The CFTC finalized rules to set collateral or margin requirements on trades between swap dealers and other firms that aren't done through clearinghouses. This is what is referred to as uncleared swaps and makes a small market a multi-trillion-dollar swaps market that isn't backed by central clearinghouse. However, this December 25th rule did not set guidelines for cross-border swaps. As written, the swaps were guaranteed by the foreign counterparty. The swaps were exempt from U.S. margin requirements, and because of this, U.S. banks have been restructuring their contracts to de-guarantee these swap transactions and move any liability for these swaps would then lie solely with the offshore operation. Now, most of this was moved to London. And so now we're in a situation where we want to hear from you according to this rule and to share with this committee concerns that you in the industry have. Because regardless of what we do here, it is you, it is the clearinghouses, it is the market participants who have to make all of this work. So, Mr. Chairman, I look forward to a good hearing, an important and timely hearing, and thank you for the time.
Thank you, Mr. Scott. And I understand Mr. Peterson, the ranking member of the full committee, has a statement that he'd like to be recognized to make.
Thank you, Mr. Chairman, and I'll be brief. I want to thank the panel of witnesses for joining us today. When we wrote Title VII of Dodd-Frank, we incorporated goals set by the G20 in response to the market's failure. We also took into account the risks posed by an opaque, top-heavy swaps market. We required standardized swaps to be cleared and to be traded in an environment with multiple market participants making both bids and offers. That clearing requirement has now been met, and we've brought stability to the market. I'm looking forward to discussing the trade execution issue today because I don't believe we have achieved the goal that we set in Dodd-Frank's in terms of the way the swaps are traded. Not much has changed. In some ways, the marketplace is worse now than it was before the crisis. The four largest dealers controlled 90% of all the swaps traded. The pre-crisis market structure, where they serve clients in one market and deal nearly exclusively with each other in the secondary market still exists. So I hope today's hearing can help us understand why this is the case, and I look forward to your testimony and yield back the time.
The chair would remind other members to submit their opening statements for the record so the witnesses may begin their testimony and ensure that there is ample time for questions. I'd like to welcome our witnesses to the table. First, we have Mr. Terrence Duffy, Executive Chairman and President of CME Group from Chicago, Illinois. We have Mr. Christopher Edmonds, Senior Vice President of Financial Markets, Intercontinental Exchange, Chicago, Illinois. Ms. Marnie Rosenberg, Global Head, Clearinghouse Risk and Strategy, J.P. Morgan Chase & Company, New York, New York. Mr. Stephen Merkel, Executive Vice President, General Counsel, and Secretary, BGC Partners, Incorporated, New York, New York, on behalf of the Wholesale Markets Brokers Association. Mr. Stephen John Berger, Director of Government and Regulatory Policy, Citadel LLC, New York, New York, on behalf of the Managed Funds Association. Mr. Luke Zabrod, Director of Risk and Regulatory Advisory Services, Chatham Financial, Kennett Square, Pennsylvania. Mr. Duffy, please begin when you're ready.
Thank you, Mr. Chairman. Chairman Scott and Ranking Member Scott, members of the subcommittee, I'm Terry Duffy, the Executive Chairman and President of CME Group, and I thank you for the opportunity to testify today regarding the G-20 clearing and trading commitments. These commitments were meant to create a global regulatory framework. However, some G20 nations have not implemented core elements of the G20 reforms consistently. For example, regulatory requirements for clearinghouses have not been defined on a coordinated basis. This has the potential to create inconsistency, uncertainty, and disruption to the smooth functioning of global derivatives markets. Fortunately, negotiations between the U.S. and the EU on equivalence were successfully resolved in February. That is when the European Commission originally granted the CFTC equivalent status. The European Securities Market Authority is now implementing that agreement. It is ensuring that the CME clearing is recognized as equivalent in advance of the June 21st date for European clearing mandate. I want to applaud Chairman Massett and his European counterparts for working through their differences and reaching a positive outcome. However, the process took too long. This created considerable uncertainty for European participants wanting to clear products in the United States. We encourage global regulators to avoid this kind of potential market disruption in the future. They should implement long-term solutions. They should not force markets to go through a national equivalence and recognition process every few years. Otherwise, regulation will artificially influence liquidity, price discovery, and risk management. It will disadvantage individual markets in an increasingly competitive global marketplace. Beyond equivalence, the global clearing mandates have also led to increased focus on clearinghouses' risk management. In 2012 and 2013, enhanced risk management standards were adopted for clearinghouses. More recently, there has been a focus on recovery and resolution. Central clearing increases transparency, reduces systemic risk, and strengthens the financial system. Clearing members and market participants bring risk to the clearinghouse through their trading activities. In contrast, a clearinghouse's core function is to manage that risk. We don't create the risks. Clearinghouses are responsible for ensuring the overall safety and soundness of their markets. CME Clearing uses a number of tools to monitor and limit the risk it manages. These include its safeguards packages and waterfall structure. They provide a firewall against a potential systemic impact of a failing clearing member. These tools have proven themselves to be extremely effective in stressed markets and during the worst financial crisis in memory. We have long supported first loss contributions to each of our financial safeguard packages. This further aligns our interests with those of market participants. We are committed to ensuring that the capital contributions from clearing members as well as CME will be sufficient to avoid the mutualization of losses in a default situation. As a result, when addressing a clearing member failure, CME Clearing has never had to access the default fund contribution of a failing clearing member, the mutualized capital of its clearing members, or the capital that CME has in its default fund. Effective risk management must strike a balance between initial margins, clearinghouse contribution capital, and clearing member guarantee fund contributions. This ensures that all market participants have appropriate incentives to manage risk across the markets. Before closing, I want to mention the leverage ratio rule adopted by the Basel Committee and the Federal Reserve. It's an example of a regulation that is at odds with the G-20 commitments to clearing. The leverage ratio will make clearing more expensive and less accessible. Why? Because it fails to recognize how customer collateral, appropriately segregated, reduces exposures. The Basel Committee recently proposed changes to the rule, but they stopped short of endorsing a segregated collateral offset for client-cleared derivatives. Customer collateral is legally required to be segregated, reduces exposures, and cannot be used to increase a clearing member's leverage. Without such an offset, clearing costs will increase. Further, moving the clients of a defaulted clearing members will be much more difficult. I thank you for your time and attention this morning. I look forward to answering any questions you may have of me.
Mr. Edmonds.
Chairman Scott, Ranking Member Scott, I am Chris Edmonds, Senior Vice President of Financial Markets for Intercontinental Exchange, or ICE. I appreciate the opportunity to appear before you today and discuss the role of clearing and trade execution. Since launching an electronic over-the-counter energy marketplace in 2000 in Atlanta, Georgia, ICE has expanded both U.S. and internationally. Over the past 16 years, we have acquired or founded derivatives exchanges and clearinghouses in the U.S., Europe, Singapore, and Canada. ICE has a successful and innovative history clearing exchange-traded derivatives and OTC derivatives such as energy and credit default swaps, or CDS. In 2008, ICE launched the first new clearinghouse in the UK in over a century, ICE Clear Europe, which clears energy, credit, and interest rate derivatives. We launched our CDS clearinghouse, ICE Clear Credit, in 2009, and it has since converted to a derivatives clearing organization following the implementation of Dodd-Frank. Following the financial crisis in 2008, global financial ministers decided to the extent possible the OTC derivative market should be cleared. Global regulators recognize that a clearinghouse, by acting as a central counterparty to transactions, minimizes bilateral risk. As a result of increased clearing, market participants are realizing that moving uncleared positions into clearing creates both operational and capital efficiencies. For example, since 2009, ICE Clear Credit and ICE Clear Europe have cleared more than $78 trillion in CDS notional, but through compression and netting currently maintain a combined open interest of approximately $1.5 trillion, significantly reducing the bilateral credit exposure among market participants and reducing systemic risk. Ironically, despite mandate-driven and natural growth in the volume of cleared contracts, the number of futures commission merchants, or FCMs, available to provide clearing services for end users has dropped from 190 to 76 in recent years. The bulk of derivatives clearing is now concentrated in a few bank-owned FCMs. These firms are constrained by the proposed requirement under Basel III that banks hold regulatory capital against clearing customer margin on their balance sheet, even though the customer margin is posted to a clearinghouse and held on a segregated basis. ICE has joined a group of concerned market participants to encourage the Basel Committee to reconsider and refine aspects of this rule. We appreciate that several members of this subcommittee have helped us raise the issue with banking regulators. The Basel Committee recently indicated it may rethink its position and has requested further comment on the proposal. ICE and the broader derivatives industry are hopeful the Basel Committee will recognize segregated and risk-reducing nature of customer funds that are restricted on bank balance sheets. We are also pleased European and U.S. regulators reached an agreement on margin equivalence standards for CCPs in their respective jurisdictions. Further coordination between regulators is still required to ensure that these standards do not create opportunities for regulatory arbitrage or balkanize global markets. But this first step brings important regulatory certainty to clearing customers. We're also hopeful the global regulators will reach agreement on equivalence between trade execution platforms within a reasonable time frame. Over the past decade, ICE has invested heavily in our clearinghouse technology, and risk management practices. ICE has kept pace with and often preceded regulatory reforms, new global rules, and international standards that have been established with respect to risk controls, levels of protection, and proper functioning of clearinghouses. We have worked closely with regulators, clearing members, and end users to implement clearing models that meet or exceed modern regulatory reforms and international standards. The result is an even more robust clearing model that includes many ICE-led initiatives, such as the introduction of skin in the game or the contribution by clearinghouses of designated amount of their own capital to the default waterfall. ICE clearinghouses are subject to extensive regulatory oversight and strong corporate governance requirements, exercised largely through risk and advisory committees and independent boards of directors. Risk committees include representatives from our clearing member firms and, in some cases, end clients. ICE clearinghouses regularly conduct margin back testing, default fund stress testing, and liquidity stress testing, the results of which are reviewed by clearing members and regulators. The ICE clearinghouses also regularly provide public disclosure of their margin back testing, default fund stress testing, and liquidity stress testing as part of their compliance with the CPI IOSCO public quantitative disclosure standards. The rules, practices, and procedures of ICE's clearinghouses are fully transparent and publicly disclosed in a consistent manner. Any material change to ICE's clearing processes are subject to rigorous internal governance review as well as applicable regulatory review and approval. Thank you for the opportunity to share our views with you. I'd be happy to answer any questions you and the members of the subcommittee may have.
Thank you, Mr. Edmonds. Ms. Rosenberg.
Thank you for holding this hearing and extending J.P. Morgan Chase the opportunity to present our views on implementation of the G-20 derivative reforms. My name is Marnie Rosenberg, and I am the Global Head of Clearinghouse Risk within J.P. Morgan Chase's independent risk management function. Our firm is a leading provider of access to clearing across the globe. The clearing mandate has benefited the system overall by reducing risk and enhancing transparency. On the other hand, it has further concentrated risk in a small number of large global CCPs and increased interconnectedness within the system. Today, one of the critical public policy issues for regulators and policymakers is ensuring that CCP risk management and governance frameworks are appropriately aligned and effective for the systemic role that CCPs have assumed. I lead a team that focuses on identifying, mitigating, and reducing our firm's CCP membership risks. And it is from this perspective that I raise three key questions for policymakers today. First, are CCPs sufficiently resilient to withstand the default of one or more clearing members or a major loss arising from an operational failure or a cybersecurity attack? Second, do CCPs have adequate plans and resources to recover from such a loss to carry on offering critical services? And finally, if they can't recover, do they have credible resolution plans to continue to provide critical services and ensure a CCP's failure does not cause broader market instability or require taxpayer assistance? Regulators, including the CFTC, have made significant progress in addressing these questions, but there remains widespread agreement that there should be more done. The starting block for resilient CCPs is a strong, effective risk governance framework. Each CCP makes the decisions with respect to how they manage risk, including setting membership and eligible collateral requirements, establishing margin levels and overall financial safeguards, and determining the products that they offer for clearing. At the same time, clearing members bear the capital consequences of loss through the collective funds they provide to the CCP for loss mutualization. Therefore, risk governance rules should evolve to ensure that those that bear potential losses have a meaningful voice with how risk is managed. This can be achieved by mandatory and meaningful consultation and inclusion of clearing members in the decision-making process, enhanced and consistent risk committee standards, and appropriate levels of a CCP's own resources at risk, often referred to as skin in the game. Robust and transparent stress testing is critical to ensuring a CCP has sufficient resources should a clearing member default. CCP-designed stress test frameworks should be subject to more prescriptive global standards, and the testing methodology should be more transparent to clearing members. This is critical for clearing members to identify and manage the risk inherent in using a specific CCP. Specifically, regulatory-driven stress tests would provide oversight and inform supervisory requirements by evaluating the adequacy of the CCP's financial safeguards. Results of these tests should be disclosed. We look forward to U.S. regulatory support on this front as global standards are developed over the next year. While resiliency is important, it's also crucial to ensure collectively that CCPs can recover from a threat to their viability in order for them to continue to provide core services to the market and avoid systemic contagion. But a CCP's ability to allocate losses to clearing members through recovery tools, such as cash calls on members, must be very limited and subject to predetermined and predictable limits. Otherwise, they can be procyclical and have a destabilizing effect on the broader market. Moreover, bank regulators today expect and demand it. Lastly, well-defined plans and pre-established resources to resolve systemically important CCPs in the case of an event are still needed. If a CCP is no longer a viable entity, it must be resolved in a manner that is not disruptive to the marketplace and without public support. An effective resolution plan does not result in wind down or liquidation. It means having tools and resources to replenish the default fund and regulatory capital and reopen for business with a recapitalized CCP that can continue to provide these critical services to the market. Thank you, and I look forward to taking questions.
Thank you, Ms. Rosenberg. Mr. Markle.
Thank you, Chairman Scott, Ranking Member Scott, and members of the subcommittee. My name is Stephen Merkel. My company, BGC Partners, is a leading global intermediary to the wholesale financial markets. I am testifying today as a director and former chairman of the Wholesale Markets Brokers Association Americas, an independent industry body representing the largest interdealer brokers. Each of our members has a CFTC registered swap execution facility, or SEF. Mr. Chairman, it has been a long, strange trip from the early versions of what would ultimately result in the Dodd-Frank Act to the current state of affairs. Generally speaking, nothing has gone as planned. The SEF rules demonstrate an interpretation inconsistent with the new Commodity Exchange Act statutory authority. The subsequent SEF registration process highlighted numerous defects in the rules. As a result of these detours, we found and find ourselves in an environment of regulatory uncertainty, fragmented liquidity, and a need for course corrections by the CFTC. Looking forward, and putting it simply, we all need to support the CFTC to fine-tune its rules and enjoy harmonious relationships around the world. I credit highly the dedicated CFTC staff who completed an enormous amount of work designing and implementing the architecture for a regulatory regime. CFTC staff has helped us through the registration process to become a SEF, accommodated us through the issuance of no action letters, staff guidance, and interpretive statements. Unfortunately, this reactive and ad hoc process cannot easily cover every problem or need and fails to provide the same regulatory certainty as APA-compliant rules. My written testimony references a series of outstanding substantive issues that need to be resolved. We are encouraged by Chairman Massad's recent statement that CFTC will seek to codify the existing no-action letters under the formal rulemaking process, and we urge them to address a wider set of issues in that release. There have also been pronounced market implications. Liquidity has fragmented by jurisdiction as non-U.S. participants seek to avoid Dodd-Frank. My written testimony cites the recent ISDA research and a Bank of England staff study on this point. The research warns that there is no sign of this trend reversing. This arrangement is not sustainable, nor is it consistent with the vision set forth in Pittsburgh in 2009. Because this is a new regulatory framework, the CFTC should regularly analyze market data to study the impact of its rules. If ISDA and the Bank of England can do this, the CFTC should too. The research should be published, conclusions publicly commented on, and the resulting product should inform future policy initiatives. The path forward for any future mutual recognition process will need to resolve the awkward regulatory relationship among jurisdictions. The current comparison of Dodd-Frank and MiFID II raises questions about whether the two can coexist, including the CFTC's past failed attempt to institute a qualified multilateral trading facility regime. There are also divergent approaches to the permitted methods of execution, with, for example, MiFID explicitly identifying auction protocols. Furthermore, the CFTC's reliance on no-action relief is a procedural tool that is not recognized in Europe. Mr. Chairman, I hope this subcommittee will encourage the CFTC to make mutual recognition and equivalency a high priority. I would be pleased to answer your questions. Thank you.
Thank you, Mr. Merkel. Mr. Berger.
Thank you. Chairman Scott, Ranking Member Scott, members of the subcommittee. My name is Stephen Berger, and I am the Director of Government and Regulatory Policy at Citadel. Citadel is a leading global financial institution that manages hedge funds and provides capital market services. I'm here today on behalf of the Managed Funds Association and its members, and I'm pleased to provide testimony as part of the committee's review of the impact of the G-20 clearing and trade execution requirements. MFA represents the majority of the world's largest hedge funds and is the primary advocate for sound business practices and thoughtful regulation of the industry. MFA continues to support reforms to the OTC derivatives markets, including central clearing and trading on open, transparent trading venues. These reforms have reduced systemic risk, increased protections for investors, promoted competition, and strengthened our nation's financial markets. I would like to highlight a few recommendations from my written statement that I believe would further help realize these benefits. With respect to clearing, MFA has been a consistent advocate for the central clearing of OTC derivatives transactions. Clearing replaces the interconnected web of counterparty exposures with a safer system where all participants face a well-regulated clearinghouse. This reduces systemic risk and enhances the stability and efficiency of our markets. Clearing also benefits investors by mitigating counterparty credit risk, increasing transparency, and facilitating greater choice of trading counterparties and platforms. In the U.S., clearing has been successfully implemented for a significant portion of the interest rate swap and index credit default swap markets. In the U.S. today, approximately 75% of these swap transactions are cleared, compared to only 16% in 2007. Notably, over the past several years, investors have successfully cleared hundreds of trillions of dollars worth of swap transactions. Nevertheless, there are two areas where further progress should be made. First, customer clearing in the U.S. must remain affordable and robust. MFA is concerned that the Basel Committee's leverage framework will needlessly but significantly increase the cost of clearing for customers by failing to recognize the exposure-reducing effects of segregated customer initial margin. The Basel leverage ratio should be modified so that it provides an offset for customer initial margin posted to a clearinghouse or segregated under U.S. rules. Second, further work is required from the CFTC and the SEC to implement a viable portfolio margining regime for the CDS market. The Dodd-Frank Act specifically sought to promote portfolio margining, which allows customers to realize margin efficiencies by recognizing offsetting risks within their portfolios. However, the interim framework that exists today falls short of meeting this goal and has adversely impacted customer clearing. Looking forward, MFA supports further efforts to expand central clearing to interest rate swaps denominated in all of the G10 currencies and to harmonize these requirements globally. While the U.S. was the first to implement central clearing, many other jurisdictions have made substantial progress in their own implementation. Notably, Europe is beginning to phase in central clearing this year, and the scope of the European clearing obligation is nearly identical to that in the U.S. Turning now to the implementation of the G20 trade execution requirements, MFA continues to support transitioning the trading of standardized liquid cleared swaps onto swap execution facilities that provide impartial access and facilitate straight-through processing to clearing. This transition promises to benefit investors by increasing market efficiency, competition, transparency, and liquidity. Recent research by the Bank of England concluded that the implementation of reforms in the U.S. interest rate swaps market yielded significant improvements in pricing and liquidity. Although the CEF market continues to evolve, a two-tier structure unfortunately persists, preventing investors from fully participating in all of the various CEF liquidity pools. This two-tier market, which reserves certain liquidity pools for dealers only and confines investors to others, hinders choice and competition, and frustrates the core principle of impartial access. A key roadblock perpetuating the two-tier CEF marketplace is the practice of post-trade name give-up, where the identities of counterparties to otherwise anonymous trades are revealed or given up post-trade. This is a legacy practice that no longer serves any legitimate purpose for cleared swaps where counterparties face clearinghouses and not each other. However, by systematically revealing private trading information, name give-up deters investors from participating on those CEFs that employ it, namely the historically dealer-to-dealer CEFs. We believe regulatory action is needed to remove this impediment to investors' impartial access to all CEFs. We appreciate the committee's oversight of derivatives clearing and trading, and I thank you for the opportunity to speak here today. I'd be happy to answer any questions.
Thank you, Mr. Berger. Mr. Zubrod.
Good morning, Chairman Scott, Ranking Member Scott, and members of the subcommittee. I thank you for the opportunity to testify today regarding certain derivatives-related aspects of Dodd-Frank. My name is Luke Zubrod, and I'm a director at Chatham Financial. Chatham is an independent firm providing advice and services to businesses that use derivatives to reduce their interest rate, foreign currency, and commodity price risks. Based in Pennsylvania, we serve 1,800 firms globally, including clients in every state represented by members of this subcommittee. Our clients' risk reduction activity benefits the global economy by allowing a range of businesses, from manufacturing to agriculture to real estate to financial services, to improve planning and forecasting and offer more stable prices to consumers and a more stable contribution to economic growth. Chatham appreciates this body's bipartisan efforts to address key concerns of non-financial end users following the passage of Dodd-Frank, including efforts to clarify that margin and clearing requirements should not apply to non-financial end users and their centralized treasury units. These efforts were instrumental in eliminating key barriers to efficient access of the derivatives market. Today, I will identify two similar barriers affecting a range of financial end users that use low volumes of derivatives to reduce risk. In particular, clearing and margin requirements, when applied to those transacting low volumes of OTC derivatives, deter such end users from managing their risks, cause them to manage their risks poorly, or dictate that they do so at significant expense. Chatham's clients facing unwarranted burdens due to clearing and/or margin requirements touch a wide variety of industries, including corporates deemed to be financial in nature, real estate and infrastructure funds that make cross-border investments in buildings, railroads, ports, etc., regional banks that are contemplating using derivatives to serve their customers, reduce risk, or compete with larger banks in their footprints, microfinance funds whose capital is directed toward enabling the world's poor to lift themselves and their families from poverty in developing countries. The first burden such firms face relates to the cost of clearing for such low-volume users. Clearing members typically charge minimum monthly fees to establish a relationship that would enable a customer to comply with the clearing mandate. These fees vary by firm and customer, but typical fees amount to $100,000 per year or more. A firm hedging interest rate risk for a single 5-year bank loan will thus obligate itself to $500,000 in fees over that period just to have the privilege of hedging in the OTC markets. The second burden relates to risk imposed by the margin requirements, which expose a company to liquidity risk that many firms are unwilling to take on. Liquidity risk is the risk that a sudden sharp movement in market conditions could force a company to come up with sums of cash that are significant to the company on short notice. In an extreme case, such margin calls could cause a firm to default on an obligation. Consider a firm with a 5-year interest rate risk concerned that in today's historically low interest rate environment, increasing rates could adversely affect their ability to make payroll. Such a firm could fully eliminate such risk by entering into a 5-year interest rate swap to lock in a fixed interest rate. On a $100 million 5-year swap subject to clearing or margin requirements, a firm would need to post approximately $2 million at inception, which could grow to as much as $12 million in a normally stressed market and $25 million in an extremely stressed market such as was seen during the financial crisis. These costs and risks create unintended consequences by negatively impacting the risk management decisions many firms make, causing them to stop hedging and retain risk that may harm business performance or even firm viability, hedge poorly in ways that cause them to retain risk, or hedge at significant expense and attempt to pass on costs to customers. While the benefits of clearing were widely understood when Congress enacted the clearing mandate, the costs were not. We now understand clearing to be a system that simply does not accommodate small and low-volume users. The consequence is that entities whose derivatives use has no ability to undermine financial stability are cut off from properly or effectively managing their risks. Small financial end users are essentially thrown into a raging sea of market volatility without a dependable life preserver. These concerns could easily be addressed if Congress exempted low-volume users from clearing and margin requirements via a financial entity's de minimis exception. Such an exception could be narrowly tailored to ensure that firms that meaningfully contribute to systemic risk would not be eligible. Such an approach is consistent with approaches adopted or proposed by Australia, Canada, Japan, and Singapore. Thank you for the opportunity to testify today, and I'm happy to address any questions you may have.
Thank you. Thank you all for your testimony. The Chair would like to remind members that they will be recognized for questioning in order of seniority for members who were here at the start of the hearing. After that, members will be recognized in order of arrival. I appreciate members' understanding. I now recognize myself for 5 minutes. Mr. Edmonds, as we start this hearing, I want to put part of today's conversation about recovery and resolution in context. U.S. clearinghouses are robust financial institutions with significant financial resources at their disposal. The recovery or resolution of a clearinghouse like ICE or CME would be unprecedented. Can you describe what would have to happen to exhaust the resources of a major clearinghouse like ICE?
So let's back up and remember what we all serve international customers, and given the European regulation around qualified CCPs coming out of the European equivalence debate that we've had, means that if you either deem systemically important, have to meet that if you're a European clearinghouse, or you're going to voluntarily subscribe to those types of robust structures. So that means that simultaneously 2 of your largest members are defaulting on exactly the same day at the same time. And your model right now has to be able to support enough collateral to hold against that happening. So if you ask me what happens if we're not going to be able to survive that, it's going to be more than what those standards are, obviously, to get to that point. And that means you're going to be in a very stressed market situation, one that is likely unprecedented. If you look back at the history of the 2008 crisis, you're going to find yourself in a position where we all stress test what those events were, the price shocks that we saw to the marketplace and the instruments that we held, or we do hold now, based on a historical look back to that. So we know we can sustain 2. We know we can sustain likely more than that, but we have to prove every day that we have tool sets in that in order to survive that. If you ask me what happens if it's 5 or 6, I'm not sure you're worried about us at that point in time. There's a bigger problem going on in the global financial markets at that point in time. But the short answer is you got to be able to hold at least more, to cover at least more than 2 going down at the same time.
Ms. Rosenberg, clearinghouses are bigger today, but as we talked about at our last hearing, clearing members are also required to hold more capital than they did before the crisis. How has this changed your concerns about clearinghouse risk?
Thank you for the question. I would just, reiterate one point that my colleagues here at the table also made, is that in terms of capital that we have to hold against the guarantee that we provide on behalf of our customers to the clearinghouse, we currently are facing a situation with the leverage ratio where the cash that we receive from our customers is actually risk reducing because it offsets the exposure that we have to the clearinghouse. And so that has been an impact from our standpoint in terms of the capital that we need to hold. And as a result, we're seeing a contraction with several other clearing members actually exiting the market, and greater concentration with respect to the market, which is not a good thing for end users.
Mr. Duffy, in a speech last year, Chairman Mossad noted that clearinghouse risk couldn't just be understood in terms of skin in the game, and that you also had to look at the full picture of policies and practices that mitigate risk. What policies and practices have changed over the last 6 years to better manage risk within your clearinghouse?
Well, there's been a number of different situations that we've done, and Mr. Edmonds outlined them, but we're all new to OTC clearing, which is what we're talking about today. I think historically, when you look at CME Group in our base businesses, which is futures, we've never had a default to date, and due to a customer loss. So that is one of the biggest issues. I think when you look at the way things are margined today, since Dodd-Frank went into place, we mark to market every day, and we can mark to market every hour. The liquidity or the capital that we accept today is different than it was as little as 5 or 10 years ago, so it's much more liquid than it was before. So I think those are a couple of the different issues that we have done to bolster our clearinghouse, and we've also, again, the risk management associated with our clearinghouse is critically important to us. The governance that's associated with our clearinghouse is important. We're working with agencies constantly. We're deemed a systemically financial market important utility now. So these are all different things that we have to cooperate with, and I think we've done a good job at it.
Thank you. I have a couple of other questions, but I'm going to try to hold to the 5-minute rule and come back for a second round of questions and try to hold every member to that as close as we can. I'll now recognize Ranking Member Mr. Scott for 5 minutes.
Thank you, Chairman Scott. My concern in this entire harmonization, cross-border equivalency issue has been to make sure that our financial firms, our clearinghouses, our market participants are not put in a competitive disadvantage in the global marketplace. And Mr. Duffy, from your testimony, I get a sense of rising concern, even though we've had the December 15th move by the CFTC, and now we've got the May 24th rule. But you still have some great concerns, and from your testimony as I was reading it, you said, and I quote here, that if this is not the case, then regulation will artificially influence liquidity, price discovery, risk management, and competitively disadvantage our market participants in an increasingly competitive global marketplace, which goes to my concern. So you're telling me that instead of let my heart not be troubled, I think you're saying let our hearts be troubled. Could you give us why you feel, even in the midst of what the great work, and I tip my hat to Chairman Massad has done, that you still have some indigestion on this issue that you and I both are very much concerned about?
Thank you, sir. One of the things that I have noticed in my 36-year career at the CME and trading for 23 of those, and then being in management for the last 15, especially going through regulation, is uncertainty for market participants. It's the worst thing you could possibly have, is not knowing what the rules of the road are. So when we talk about the equivalence equation that was originally done in February, what happens is they keep bumping up against the dates that the market participants aren't certain what the rules or the regs are going to be, so what jurisdiction they can participate in. And that's exactly what happened again under the equivalence. And as you know, we were waiting for the ESMA recognition, which I referenced in my testimony, which hopefully we were getting today or tomorrow, but we need to have that by June 21st. So we're trying to keep participants knowing what their capital costs are going to be if they're going to clear at a U.S. entity or not, because they're going to be completely different if we're not recognized, and we can't continue to bump up against these dates. So I think certainty is the clearest thing I can say to that, sir.
All right. And Mr. Edmondson, let me ask you, first of all, I want you to give me an update on where we are with equivalence for clearinghouses.
Well, as Mr. Duffy said, we still have these dates. So we know where we're going to land the airplane. We may not know when we're going to land that airplane is the easiest way I could give you that analogy. So the conceptual agreement that the global regulators have on the equivalency, I think, is well understood. It's still the details in that concept that are causing some people angst. And as you articulated in previous comments, on that. So, I mean, things like anti-procyclicality measures, you have 3 different options that you can use in order to meet the global benchmark. Well, no one yet knows which of those 3 everyone's going to use at a given time. So we know we have to get to that end point, but that end point is not yet, and while that end point is well-defined, the end point, the path there is not yet well-defined. That's
All right.
what we're going to have.
And Ms. Rosenberg, let me ask you, do you think that the clearing mandate that we have has been a positive development? And if not, or even if so, what more do you specifically think the CFTC should do?
Thank you for the question. So I think that the G20 global derivatives reforms overall have made the system safer and more resilient and increased transparency. It's been several years now since global standards have been developed for clearinghouses. They were set in 2012 by the global standard setter, CPMI-OSCO. We believe it's time, and it has been, and regulators have been taking a step back over the last 18 months to revisit those standards, as market participants have raised concerns about different areas, which I spoke about in my oral remarks, which is CCP risk governance and capital contributions, stress testing, specifically setting minimum prescriptive standards for clearinghouse stress testing, as well as with respect to stress testing, ensuring that there's a supervisory regulatory-driven stress test that reviews those financial safeguards to ensure that they are adequate. CPMI-OSCO has taken that feedback on board from market participants and is in the process of developing a market consultation to cover all of these areas: capital, skin in the game, governance, margin, as well as stress testing. And we look forward to U.S. regulatory participation and support, including the CFTC, in those discussions.
Thank you very much, Mr. Chairman.
Now recognize Mr. Lucas.
Thank you, Mr. Chairman, and I appreciate you holding this hearing. These obviously are complex issues, and it's an example of why it's so important that we hear directly from the financial sector that's impacted by the reforms that have taken place in our markets and our market participants. I'd like to continue the discussion that's been going on about the CCP risk management and the equivalency, and my first question, I guess, essentially I'll throw out to the crowd. It becomes quite clear there's an agreement with the panel that significant progress has been made in enhancing the standards for risk management at CCPs, and that global coordination among regulators in developing those standards. And obviously, the European Commission is preparing legislation to address CCP recovery and resolution. Would the group, and whoever would prefer to go in what order, I don't care, would you expand for a bit about the various challenges that the CCP equivalency agreement that was just reached between CFTC and European Commission represent to your industry and ultimately to my consumers, your customers?
I mean, I'll start. I think that the agreement that we reached is one of those agreements that, as I said earlier, took way too long, which could affect the consumers because of the uncertainty of it. I think that we had to bend it a little bit here in the United States in order to get deemed equivalent, which concerns us a little bit. We want to make certain that our regulators are regulating the U.S. markets and not a foreign regulator regulating the U.S. markets. That's the way I look at it. So I don't want them being our prudential regulator. I think there was a lot of back and forth, and hopefully we're in a place right now. Mr. Edmonds mentioned pro-cyclicality. There's been a lot of pro-cyclicality back and forth on these agreements that we never had to adhere to before as a U.S. entity that we're adhering to today in order to be deemed equivalent in the European Union. Maybe that's just progress the way it goes back and forth, but I think overall it should not hurt the business here in the United States now that we've gotten to a certain point.
Absolutely, and that makes me think of Mr. Scott, the ranking member's comment about the disadvantage. I don't think anyone in this committee wants the industry in the United States or the participants here to be put at a disadvantage. And where are we in those circumstances? And I throw that again to the rest of the panel.
So one of the things going on in Europe right now is that the European Commission, we expect to be drafting legislation on CCP recovery and resolution, We expect that to come out close to the end of the year. I suspect it could go into next year. In any case, in the U.S. market, we don't require any specific legislation to implement recovery and resolution standards, okay? What we want to make sure about also is that any legislation that's developed in Europe does not cause differences with the U.S. rules and legal environment. The Financial Stability Board is in the process of developing global standards with respect to resolution planning for clearinghouses, what the guidance should be around developing those plans for resolution authorities with respect to CCPs. We would encourage the Europeans and Chairman Massad through his discussions with the European Commission to ensure that those standards that are developed are consistent across Europe and U.S. We wouldn't want any differences and go through another equivalence type of discussion that we've had and Mr. Duffy elaborated on.
Mr. Duffy.
You know, what I think is important is we do have a resolution recovery and stress testing here on the U.S. CCPs that's overseen by our regulator. I don't disagree with my colleague. It'd be nice to have a uniform approach across the globe, but what's important to us is that we do have that within our U.S. regulator right now.
Ms. Rosenberg, let's continue along this vein. Could you discuss with us for a moment the current models for stress testing, what exists, weaknesses that might exist, how those could be addressed? Because it seems, and Mr. Edmondson too for that matter, it seems that the stress testing process, modeling, is absolutely important.
Yeah, it absolutely is important. And I just want to, you know, my partners over here, Mr. Edmonds and Mr. Duffy, I don't want there to be any perception that they're kind of, the companies they work for, that the stress testing models are not robust or anything like that. What I'm talking about is I have responsibility for overseeing JP Morgan's 50 derivative clearinghouse memberships globally. And from that perspective, I will say that the current global standards rules that govern clearinghouses on stress testing are very light. They effectively say that clearinghouses should stress test their portfolios and use scenarios that are extreme but plausible. It's very light on the prescriptive standards. And so what we've raised, JP Morgan, other clearing members, as well as end users, to the global standard setters, that there needs to be more prescriptive standards. And that would cover, you know, kind of assumptions and kind of basic parameters about how that work should be done. Separate from that, we do believe that there should be, like ESMA has just completed. ESMA is the European regulator that oversees CCPs in Europe. They just completed a stress test overseen by the regulator across 17 European CCPs. And we believe, and the results were transparent to the market, and we believe something like that would provide more confidence in CCP structures.
Mr. Chairman, my time has expired, but if there's another round, we may continue down this vein.
Yes, sir, and it expired a minute ago. Chair now recognizes the gentleman from California, Mr. Aguilar.
Thank you, Chairman Scott, and I don't want to be admonished, so I will make sure I stick to my time. Some of my colleagues have gone down this road, and Mr. Edmonds, you talked about the global nature of this market. Ms. Rosenberg, you just mentioned and commented on the same from the regulatory framework abroad. So I'll make this to Mr. Berger, Mr. Merkel, Ms. Rosenberg, and Mr. Zabrod. Can we go down that path a little further? I'm interested to know on the financial regulatory structure in other countries and how that's going to impact the swaps market. Ms. Rosenberg, you just talked about the European discussion moving forward, and earlier you talked about continued discussions in the regulatory structure abroad. Can we talk about the impact that will have on the U.S. swaps market?
Sure, I'm happy to start. Thank you for that question. That's a very important question. So one of the things we have seen with respect to CEFs and market liquidity is that there could be certain enhancements made in the U.S. to curtail the current market fragmentation that we've seen between Europe and the U.S. We expect the European regulators to develop specific rules around CEFs going into next year. And currently, the U.S. rules are very prescriptive with respect to how dealers, swap dealers, can execute trades. And we do believe that there needs to be more flexibility on that front because we expect that's where the Europeans are going. And that is very important. I do believe that the CFTC and Chairman Massett are very supportive of this.
Mr. Merkel?
I would agree with that. What we have seen is I think there were good intentions on the part of the CFTC to try to lead and try to get other jurisdictions to have to harmonize forms of execution. It just didn't work. What ultimately ended up happening was chased away non-U.S. participants and led to markets developing outside the United States, which did fragment liquidity. It's not a crisis, it's just unfortunate and doesn't really benefit anyone. From our perspective, we'll do the business wherever it is. We'll do it in New York, we'll do it in London. And we'll have to see what happens with MiFID II and how the U.S. agency approaches it. I do think that one should be realistic and be somewhat courteous of what's going on in Europe and understand that they don't have to come here. And it may well be we may face a situation in which at some point U.S. firms aren't going to be able to do business in Europe as easily, and that I think would be unfortunate for a number of reasons. And the best way to do this, I think, is to encourage what we think is starting to occur, which is a different approach that Chairman Massett is taking, and to see what develops. So I think we're in an optimistic, cautiously optimistic mode, provided something happens. If nothing occurs, we're going to have a problem. I just don't at the moment think I'm going to be optimistic that that's not likely.
Thank you. Mr. Berger?
I think we are likewise optimistic that a harmonized and mutually recognized regime can be put in place for both clearing and trading. On the clearing front, as I noted in my opening remarks, the scope of the clearing obligation that's going to be phased in Europe beginning this year is identical in scope to what's been already put in place in the U.S. On the execution side, I think the good news is there's common architecture that has been developed. Europe has adopted the same execution to clearing workflow and straight-through processing rules that the CFTC has put in place. And there's a commitment in both regimes that trading venues should provide impartial and non-discriminatory access to all market participants. So I think there is a path forward. Obviously, the European regime is a few years behind. Clearing is just being phased in there this year, and we phased clearing in 2013. And as other commenters have noted, the MiFID II reforms, which will affect trading in Europe, come into effect in 2018. So there is a timing differential, but I think the objectives and the end state is consistent across both.
Thank you. Mr. Broad, real briefly.
Yes, I'll note with respect to my testimony, the comparison with Singapore, Australia, Japan, and Canada. These are governments who have enacted what amounts to exceptions to clearing and/or margin in their regimes. And I think the implication for them is that such market participants will not be unnecessarily burdened, whereas those here in U.S. markets will be by these requirements.
Thank you. Thank you, Mr. Chairman.
Chair now recognizes Mr. Nagelbauer for 5 minutes.
Thank you, Mr. Chairman. Mr. Duffy, Mr. Edmonds, we talked a lot about clearinghouse governance, and so how do you determine what level of risk a clearinghouse takes on, and then what are your primary tools then you use to manage that risk?
So those decisions are made at a risk committee level, which is defined part of the governance structure. A recommendation is made, whether it's a new product, a new member coming into the clearinghouse is going to bring their own level of customer flow into the clearinghouse at a time. And once that decision is made to launch those new products or to add on to that new member, we're constantly looking at the entire book, the match book. At no point in time do we run an unmatched book. The only time that ever happens is if one of the members is defaulting, and our job at that moment in time is to bring it back to match book as quickly and as efficiently as possible with as little disruption to the marketplace as possible. So making certain that all of the members that we govern through the clearinghouse structure and the way it's set up under the CFTC, that we understand that the risk they're bringing and the collateral they bring to support that risk on a daily basis is the function of the clearinghouse and continues to be the primary responsibility that we have to the marketplace. From a tools perspective, this is everything in the waterfall. Membership, not everyone qualifies. If I have $5 and you have $5 million, chances are you're a better member than I am at that day, okay? So making sure that the qualified members there, making sure that their operational risk controls are there, that can they process the customer flow? Our members, very important partners with us, ultimately make the decision of who gets access to our clearinghouse services. So if they've done a poor job, we need to be able to spot that. We need to be able to have a consultation with them. We don't like this position. It's too concentrated. If it's too concentrated, there are other premiums and collateral we bring in there. You may want to hold a very concentrated position, and we may be able to get comfortable with that, but you might be collateralizing that more than 100% of the risk that we hold. If that's something you're willing to pay, we'll take that at the end of the day. And then making sure that we get all the way down through, okay, what happens if it goes the wrong way? What happens if the collateral wasn't what we thought it was going to be? How do we manage that process? All through, again, membership committee. It's the same for every single person. No one's making a bilateral decision. Clearing member A gets this function, clearing member B gets a separate function. Everyone's managed to absolutely the same standard at all times.
I would just add, I agree with Mr. Edmonds completely on everything he said there, but I would just add that, you know, one of the things that we have the ability to do when we got it under the Dodd-Frank Act, which was critically important when we're talking about swaps, is the ability to reject a swap at the clearinghouse CCP level if we're not comfortable with the risk that it's bringing into our institution. So I think that's something we use. Margin is another tool that Mr. Edmonds also referenced. I think margin is something that is important for the CCPs always to have the ability to set. We're not interested in if the price goes up or down. We're interested in managing the risk. So these are the tools that we have put in place today. And I think, you know, I'm only outlining a couple of them. I think Mr. Edmonds did a good job outlining the others, but these are critically important tools. When you don't have an interest in the market going up or down, that's who should be setting the margin, and the ability to reject something that you're not quite sure how to risk manage is also critically important.
The leverage ratio, several of you alluded to that, and so the question I have is, on the leverage ratio, and we talked, I think somebody said it would cause margins to go up, so in order to adhere to whatever the leverage ratio is pegged at, would you get credit for additional margin that you request from your members, or so?
No, that's a bit of the perplexing piece, because the more margin our members collect on their client positions and post to us, the way the rules currently stand today, the more capital they have to hold against it. So at a time when we're trying to encourage more and more individuals to use clearing services because of the risk-reducing nature of it, we're adding that cost. The more collateral we get, the more the bank clearing members are having to hold against that. Well, they have to then charge for holding that capital against that from a regulatory capital perspective. That increases the cost to your end clients. And that's where this thing begins to spiral out, and where people are making the decision today, if they possibly can, to choose not to be in that situation.
That's counterintuitive. In other words, what you're saying is the less risky you make that position, the more capital that you have to keep. Do I understand that correctly?
You do, and yes, it sounds illogical, and we're trying to have a logical conversation.
Mr. Duffy.
May I just jump in real quick? What I think is critically important, and Ms. Rosenberg can answer this better than any of us because this affects her more than anybody, but what's important is her bank or any other bank cannot touch that collateral. It's in the clearinghouse because it's segregated. So there's no reason to have a leverage ratio charge put up against it. They have no access to that capital or collateral.
Chair now recognizes Mr. Davis from Illinois for 5.
Thank you. Thank you, Mr. Chairman, and thank you to everyone for coming here today to talk about this important issue. A lot of the questions that I had plan to ask have been asked by my colleagues, and that's the benefit of being a little further down the seniority ladder like we are. So let me start with you, Mr. Zabrod. Can you go into a little more detail on the impact to agricultural and energy firms moving away from the swaps market to the futures market to possibly hedge their risks?
It's a good question, and I appreciate its premise. I think if I can discern correctly, I think the premise is that we should really give due consideration to players who are involved in helping to provide price stability to the kitchen table, to energy bills that consumers pay at home. I think my view on kind of the key obstacles to smaller players like that in accessing the markets, it tends to be focused again on the issue of clearing and margin costs for those smaller players, not necessarily the obstacles, for example, created by CEFs or other things. I think there are legitimate debates about whether or not one needs to be prescriptive in defining all aspects of how CEFs need to operate. But that being said, I think that's not the key obstacle for a lot of the clients that we work with in accessing the markets. It's the significant costs associated with clearing and margin.
Okay, do you have any suggestions to address some of these obstacles?
Yeah, again, for the clearing and margin requirements, I think it could be addressed very simply. And I think the simplistic solution is to exempt small, low-volume players from the clearing and margin requirements.
Okay. Mr. Duffy, how are you, sir? I'm good, sir. How are you? Good. Nice to see you're on your wing again here. As many of you know, it was named the Terry Duffy Wing, one of the last subcommittee hearings that I had. It was just me that named it, so sorry, Terry. We don't have a plaque up yet. Can you fix that, Chairman Scott? How does Mr. Duffy, how does the CME strike the appropriate balance between profits and risk management?
And risk management?
Yeah, how does your company strike the balance between profits and risk management?
Risk management comes first, sir. I mean, without risk management, we don't have profits. I've said this a million times over. The credibility of our marketplace is the utmost importance to CME Group. We cannot shortcut any of the risk management tools or protocols that we put into place or continue to put into place, or we will not have shareholders. So we do not put profits in front of risk management. Again, this is something that is near and dear to my heart and near and dear to everybody in the organization, because we will not shortcut that process 1 cent.
Well, we appreciate that. And I will yield back the balance of my time, Mr. Chairman.
Thank you, Mr. Davis. I now recognize Mr. Kelly from Mississippi for 5 minutes.
Thank you, Mr. Chairman and Ranking Member Scott, for having this hearing, and thank you, witnesses, for being here. I've been in and out, so if I ask you something that's already been asked, I apologize. Mr. Davis talks funny beside me, so I know that you guys can understand my accent much better than his. Ms. Rosenberg, and you were partially answering this when I walked back in, but if you want to add anything, has the clearing mandate been a positive development for the market?
Thank you for the question. Yes, we believe it has been a positive development for the market. The G-20 reforms have made the system safer and more transparent. And what we are collectively doing now, market participants, as well as regulators and clearinghouses, are reviewing current standards. We do expect market consultation at the global level to come out over the next couple months to cover many of these standards that are being revisited. And they include stress testing, initial margin, governance, as well as recovery tools. And we look forward to providing that input into that process.
And kind of as an unintended follow-up, I guess, as a member of many clearinghouses, does your firm have any say in the products that are cleared in each venue? And do you have any concerns about the products that might be cleared in the central clearing counterparties J.P. Morgan is a member of? And further, do you think the capital and margin rules are incentivizing products to be cleared that perhaps shouldn't be?
that's near and dear to our firm's heart, as well as other clearing firms. So what I haven't said in my testimony is that J.P. Morgan, as a firm, there are employees at J.P. Morgan that do sit on clearinghouse risk committees. But that role that we participate in is as a fiduciary on behalf of the clearinghouse or as a market expert. It's not representing us as a clearing firm. So what we have seen, and we expect it to continue to go in this direction, particularly with the non-cleared margin rules coming out starting in September. There is an interest by participants and CCPs to clear more products. There's going to be a demand to clear more products, even if they're not mandated, more complex products. And we do think there needs to be more involvement in key stakeholders like members through a mandatory consultation process early in determining whether a product is suitable to clearing, because the impact of clearing more complex products could impact our capital that we contribute through the loss mutualization process.
Mr. Berger, I'm talking about swaps execution facility, the SEF. Can market participants limit themselves to using only one SEF, or do they need to use multiple SEF? And if the latter, if they need to use multiple SEFs, what problems does that pose?
Market participants are free to use one or multiple SEFs. I think many buy-side market participants use the two SEFs that serve the buy-side community are Bloomberg or TradeWeb, so many buy-side market participants will use one or both of those venues. There are probably serving the interest rate swap market and the credit default swap market 8 or 9 SEFs that have a decent amount of liquidity. One of the concerns that the Managed Funds Association has, however, is that there are really only 2 SEFs that are truly open and accessible to customers in the market, and 5 or 6 of the other SEFs that have liquidity have maintained certain barriers. So it would be beneficial if investors could access the full array of swap execution facilities that have liquidity.
Thank you. And Mr. Edmonds, we talk a lot about models and stress testing. How good are the models, and how do we know that the models developed will work in a time of stress?
We have to use the best information available to us at the time. I mean, I will tell you, spending time running my previous role at ICE, running the CDS clearinghouse, we went back and we continue to look back at the 2008 crisis. And we look at that and we said, what if it was 2 times as big? What if the price differential from the Lehman Brothers default and its impact on credit default swaps was 200% of what we witnessed that day? And we still hold enough capital against that today. If it's 400%, we might have a different conversation, but as I said earlier in one of my remarks, I might not be the thing you're looking at that day. It might be a much bigger piece.
And thank you, Mr. Chairman. I yield back.
We're going to go on our second round of questioning now, and yield myself 5 minutes. Mr. Berger, members of your firm have been enthusiastic about the impact of Dodd-Frank on cleared derivatives transactions and have worked hard to build a business as a non-traditional liquidity provider in certain swaps. Do you see the success of Citadel as the new model for swaps liquidity as banks retreat from their traditional role in these markets?
Just one note up front. I'm here today representing Citadel's hedge funds businesses, speaking on behalf of the Managed Funds Association, and Citadel Securities, which conducts swap market-making activities, operates independently of Citadel's hedge funds. That said, I think a central goal of the swap markets reforms was to lower barriers to entry and increase competition, and I think that does directly benefit investors by providing more competitive pricing and more diverse sources of liquidity beyond the historical incumbent intermediaries in the marketplace.
Do you think that all swaps markets are suitable for electronic market making? And are there any liquidity challenges created by Dodd-Frank despite the success you've seen at Citadel?
I don't think all swap markets are suitable for electronic trading. There are portions of the swap market that remain uncleared, for example, but the portions of the swap market that are cleared and that are highly liquid and transparent, I think are standardized, liquid, and transparent, are appropriate to trade on-swap execution facilities through electronic RFQ and order books as well. I think research that's looked at the impact of the migration to SEF trading has shown that it has improved pricing and liquidity. We've heard reference today already to the Bank of England research that was released earlier this year, at the end of last year, that reached that conclusion, and that research has been independently validated by some other market researchers, including Aclaris. So I think there are tangible benefits that market participants are realizing from these reforms.
So you think it's improved liquidity, and you don't see any challenges with liquidity because of it?
I think that it has improved pricing and liquidity, and the challenges that exist with respect to liquidity in the marketplace are best addressed by ensuring that more market participants can join all the venues that are available, and that there are more diverse means of risk transfer and price discovery, and so that a broader array of market participants who can be both price makers and price takers in a more kind of diverse marketplace is the long-term solution to any liquidity challenges we face today.
All right. Ms. Rosenberg, late last week, the European Union announced that it was delaying its margin for uncleared swaps rules. Chairman Conway stated that this is yet another failure of international cooperation which will have real consequences for U.S. market participants. How does this sudden shift in coordination impact a bank like J.P. Morgan, and what other potential failures of cooperation are you worried about?
Press the wrong button, sorry.
That's all right.
This is a really important question, and it is something that policymakers and regulators need to be focused on. As you mentioned, it's a recent announcement. It just happened on Friday, and we're still considering the implications for J.P. Morgan. But our initial concern is that it may create a disadvantage for U.S. banks. A primary priority for the industry throughout the development of these rules, these margin rules, has been consistency in content and timing. So we don't want a delay in timing in one jurisdiction that could create undue burden or lack of competitiveness for U.S. firms.
Mr. Sabrad, if U.S. regulators go it alone with the uncleared margin rule because the European Union failed to follow through with its commitments, what will be the impact of end users like your clients?
Sure, thanks for the question. I would say global margin rules really reflected the most careful and deliberate process across all of derivatives regulation to reach a globally coordinated outcome and to line up the start dates globally as well. And so I think it would be valuable to endeavor to retain a key benefit of that coordination by maintaining those aligned start dates. I think failures to do so will drive imbalances in counterparty selection that have competitive implications. For example, if I were a European entity and I had the choice of facing a European bank or a U.S. bank, one who was subject to U.S. margin rules that started earlier and another who was subject to European rules that had not yet taken effect. If those start dates didn't match, I would have the incentive to transact with the European bank. So that's certainly a real-world implication of becoming misaligned on those dates, and I think I think we should endeavor to move forward in lockstep with Europe.
Well, thank you. I'm going to, Mr. Conway, Chairman.
Thank you, Chairman. I apologize for popping in and out, but thank you all for being here. In Chris Giancarlo's white paper in 2015, he was critical of the limitation on methods of execution available for swap SCFs, which was neither in the G-20 rules and or Dodd-Frank, but was a part of the Gensler regime. Can any of you comment on the impact that that limitation has on the way you do your business, good or bad? Yeah, Mr. Merkel.
Thank you, Mr. Chairman. We would agree with Commissioner Giancarlo in that respect. We faced at the WNBA early on, there had been a bias towards exchanges and towards electronic marketplaces, and we worked hard to make sure that Dodd-Frank ultimately provided a technology-neutral approach with respect to really marketplaces that used any means of interstate commerce, and we thought at that point that the debate was over, but it would turn out it was just beginning. When the proposed rules came out, they were constrained. They really were. They continued to have issues with voice brokerage. There were issues with respect to trying to put in and prevent certain matching protocols that otherwise should have been permitted and were successful all over the world. But the agency didn't want. Over time, I think we were able to work with the staff to get to a better place, but we continue to have some regulatory uncertainty. Letters for relief or guidance have been unanswered. Other areas we're in a tacit form, and you see that MiFID II has a much more expansive and flexible approach to execution than you see here. I think. Well, again, I'm optimistic that it will all be harmonized. We have noticed that it has taken time, and it has been difficult to get to where we have finally gotten to with respect to most, but not all, of the auction protocols. Some of the issue may be that, for the most part, agency was used to futures exchanges are not necessarily over-the-counter markets, and what you see in the over-the-counter markets are a much broader range of methods of execution, levels of opacity versus transparency. And where we see where the swaps markets has been most successful and derivatives are most robustly traded is where you don't limit the means of execution.
Mr. Edmonds?
I would echo that point. I mean, from a clearinghouse perspective, I mean, certainly, we run exchange businesses and we have execution protocols. But from the goal of the G20 was to reduce the risk. And the only way you're going to achieve that goal at the end of the day is to be as open and agnostic as possible of how that trade is executed. But once it's executed, it goes into a system that is very regulated, very transparent, and understood about how the risk is going to be managed. And if we're going to do things that take us down a path different than that, we're not going to achieve the ultimate efficiency of that goal.
I know that the Chairman has asked about that delay in the Europeans on their uncleared swaps margin. Is there an argument to be made that the U.S. and the Asian markets should continue with that implementation date, because this is simply the biggest banks dealer to dealer, and it really won't have any real impact? Is there an argument to be made like that as to why it would be okay for the Europeans? Would not be necessarily a competitive disadvantage to all the rest of the markets in the world if Europe delays it by a year? Anybody?
I'm sure Ms. Rosenberg could speak as well as anybody on this issue, but this puts the U.S. banks at a huge disadvantage to the European banks, just for the example that was laid out at the end of the table here. So I'm hopeful that this implementation date that the U.S. and other countries around the world are looking at can be postponed in coordination with the European date. So I just think it puts the U.S. banks at a huge disadvantage.
How would the argument go is just to say that, we really can't, if we make international agreements, we all agree to a date, and then when we get right here at the last minute, we let the lowest common denominator drop out, and then we're going to reward that bad behavior by delaying everybody else. Is there arguments that way to say, look, we're going to stick with it, and you guys are going to have to come to the table and get your job done the way that you should have done it? We agreed to a year ago, Ms. Rosenberg? Or anybody?
I was just going to say that the date that's going to be the most impactful from a U.S. bank perspective is the phase 2, when the customers start having to post non-cleared margin. So that's later on to next year. As I said, we haven't looked at the full implications for J.P. Morgan as a firm in terms of the impacts, whether it be 6 or 9 months. And we're happy to provide more feedback on that once we.
Well, obviously, since it just happened Friday, I know a lot of folks are just trying to figure out who did what to whom on that kind of person.
Yeah.
Thank you very much. Appreciate it. Mr. Berger, you had a comment?
It may be obvious, but I did want to make the point that there's always a trade-off between U.S. regulators wanting to insist on certain safety, prudential, or fairness issues to govern its participants against what the effect would be on a global basis. And I think they have to make a judgment at what point they need to insist upon the virtues and I understand what the negative consequences would be. But it does seem as though this particular area is one in which one would expect there should be some flexibility as to the date of implementation. There does not seem to be a great urgency about it, and there would seem to be some benefit in trying to see whether or not there can be a coordination globally.
Yeah, Mr. Berger, you had a comment?
Thank you. I was just going to add that the timeline in both the U.S. and Europe for the implementation of these rules is phased in from 2016 to 2020, as initially envisaged, and the new uncleared margin rules don't hit the end user or buy-side community until 2019, based on the different thresholds they've set. So the September 2016 date that is being discussed now is relevant for counterparties with above $3 trillion notional in uncleared derivatives outstanding. So that's really a handful of the biggest banks, but there's not a direct impact, at least on the end user or client community.
All right. Mr. Chairman, thank you for your indulgence. I yield back.
Thank you. Chair now recognizes Mr. Scott.
Yeah, I want to, excuse me, I want to get a clarity now. The date of implementation is September, what did you say?
September 1st, 2016 is the first implementation date.
Mm-hmm. And so, Mr. Duffy, you're saying that that date puts our U.S. businesses at a competitive disadvantage if we don't move it back.
Well, it certainly could. Ms. Rosenberg obviously works for a very global bank, and maybe it won't affect their European business or not. I'm not sure, but the banks that are just primarily U.S. banks, I think you guys are a U.S. regulated bank, so it will affect them. But the point is, and it's a good point, and the chairman raised it, this just came out Friday. Details are a little sketchy, and the implementation date of 2016 and then followed on by 2017. But it goes back to my further point, Mr. Scott, and this is just another example of how we're going to have uncertainty in the marketplace where the market does not need uncertainty, it needs clarity. And one of the things that I've heard here amongst this panel, which have said you on a whole host of issues, is we need to have continuity within our European and Asian counterparts so we can have one set of rules.
I see. And you say, Ms. Rosenberg?
I would just add to what Mr. Duffy just said, which is it is very complex. We're looking at our legal entities. We're looking at our counterparties. We're looking at where we do swaps and who we do swaps with. In September, it will impact U.S. banks, which means any counterparty that we do business with will have to post non-cleared margin to us. So in that instance, if our counterparties can operate or trade and execute with non-U.S. counterparties where they don't have to post margin, then they may choose to do so. So that's sort of that's what we're evaluating right now, what that impact could be.
So when should we do it? I mean,
well,
as the chairman has said, and we've been kicking the can down the road, kicking the can down the road, kicking the can down the road. 3 years, 2 years, I don't know. So, and this committee does not want to move in any way. We're very, very, very cautious about putting our United States companies in at a competitive disadvantage. And if you all, the banks, the clearinghouses, are agreeing that this does, let me ask you to describe that competitive disadvantage if we don't do it. What would that cause you to do?
So I think in terms of how it would impact us, it could, counterparties could choose to execute a swap and clear a swap bilaterally with a European counterparty that's not yet subject to these uncleared margin rules. Okay. I mean, that's the base of it. I would say that, our folks internally at JP Morgan, are looking to see how much of an impact that could be. But I think it gets back to the timing and the differences in timing. And there was a real effort that was put forth to have consistent standards and consistent timing of implementation to avoid things like this. So I think, we are, as I said, we are looking at this, and we can come back to you with more information once we've done the full evaluation.
Is there anybody could say, is there a dollar figure? Is there something that is tangible that the regulators, the CFTC, or whoever we would need to talk to about this date, that we could say X amount of money would be lost? Is there something we could put our hands around to really show how large and how significant impact this would be on our American businesses if we do not adjust this September date?
I don't know that we could say a dollar amount, but you could say that there's a limitation in choice. Because if you're going to deal, assuming the date doesn't move, you're going to deal with a U.S. counterparty that is going to have to charge you some number. You may have the option to deal with a European entity that is not required to charge you some number. So if you decide that all things else being equal, you're just going to take the path of least resistance as long as you can, that may be fine, but you also may have much, much less choice as to the number of counterparties that you can deal with. And the European counterparties, realizing that you have less choice, might have the ability to increase that cost for their benefit to you.
I see. Thank you, Mr. Chairman.
Chair now recognizes Mr. Lucas for 5 minutes.
Thank you, Mr. Chairman. Just in the way of a follow-up, Mr. Duffy, any more observations about stress test issues, weaknesses, overcoming those? The earlier discussion we had, you seemed to have an observation.
On the stress tests, the only thing I was pointing out was that I didn't want to have the perception that CCPs in the United States don't have stress tests under its U.S. regulator, which we do. I do agree with Ms. Rosenberg, we need to have coordination with our European counterparts on this because of the businesses that they run. I think JP Morgan, you said, has 71 different clearing entities that they're associated with. So I understand that part, but the only thing I was trying to stress was that we do have very rigorous stress tests that are overseen by our U.S. regulator today. They're just not a global standard, to Ms. Rosenberg's point.
So it's an ongoing, evolving process. You all are completely engaged.
It's always going to be ongoing, absolutely.
With that, Mr. Chairman, I yield back.
Thank you. Mr. Conaway, do you have any follow-ups? Mr. Scott, do you have recognized the ranking member to make any closing remarks? He has.
Well, again, Mr. Chairman, this has been a very timely and, quite honestly, necessary hearing. It's been very revealing. We do have some issues and concerns here. I do think we need to certainly take into consideration the concerns that several of the panelists have raised, particularly regarding take a good jaundiced eye look at this date. We certainly don't want to put our businesses in a disadvantage. This is an evolving issue. It's complicated. It's confusing. You're trying to get 20 nations to harmonize, and do it on a timely basis. We do not want to do anything that would hurt American businesses. That is my concern. I'm also concerned about this Basel III situation and the ratio. I think that is a serious issue too. So I come away from this hearing with a heightened sense of concern. I think our committee needs to make sure we address all these issues and make sure we communicate with the FTC and continue to shoulder on. And we hope we can move forward and get an execution date. But I'd certainly want to see some of these issues examined and cleared. Thank you, Mr. Chairman.
Thank you, Mr. Scott. Ma'am, gentlemen, thank you for being here and participating in this hearing. Under the rules of the committee, the record of today's hearing will remain open for 10 calendar days to receive additional material and supplementary written responses from the witnesses to any questions posed by members. This hearing of the Subcommittee on Commodity Exchanges, Energy, and Credit is adjourned.